The leaders of the first half were tech and consumer discretionary, and they're now trailing other sectors. Meantime, energy, after a mediocre first half, is now leading the way. So should we expect this new trend to persist into year-end or not? Let's ask Chris Senyek. He's Wolfe Research's chief investment strategist. Good to see you, Chris. Would you stick with the new trend or go back to the old one?
Hi, Kelly. Thanks for having me on. I think it's a mix of both is the short answer. Energy performance in the first half was very mediocre, and then the second half is a top-performing sector. And it's our favorite sector because, as you saw the news earlier today, OPEC Plus is very committed to their cuts, along with a resilient economy, and even in the face of China, oil's held up relatively well. So we're sticking with energy as our top pick into year-end, which, oddly enough, is the best-performing sector so far in this half.
Right, so it's up 12% versus a 7% drop in the first half. But if I'm a big hedge fund who's looking for a high, I'm not sure I'm ready to jump on that horse, right? Who do you think, do you expect the investment world, broadly speaking, to remain kind of over-indexed to mega-cap tech?
I think so. I mean, we've told investors in a note today to really stick with the barbell approach. We think that the market will go into two phases here in the back half of the year. First phase will be, slowdown is good news because it means inflation's coming down. And in that environment, I think folks are going to want to continue to be overweight the technology and consumer services sector. And I think as we go deep into the year, I think people will get a little bit more weary into owning tech. But tech continues to be the leader. So we like tech, we like energy, we like comm services. On the other end, we'd be avoiding discretionary. We'd be avoiding some of the industrial stocks, which I think are going to have trouble with the weakness that seemingly is very persistent out of China, combined with extended valuations.
So consumer discretionary, you're not as bullish on. Industrials, you're a little bit worried about the China. But you do think tech, which is only up 1% this half after a 42% jump in the first half, you think tech's going to be okay?
I think tech will be okay. Tech is fighting against higher interest rates, right? And over the very near term, we think long-term interest rates push higher as the Bank of Japan moves away from zero interest rates. Oil having upward pressure puts upward pressure on long-term break-even rates and interest rates. So tech, I don't think, is going to be the top-performing sector, but I think you still have to own it, but just not as much as perhaps as you owned early in the year. It's fighting against the economy because tech is very much traded with the economy year-to-date, surprisingly. And I think over the near term, it's fighting against these higher rates. I think ultimately rates will be lower at year-end than they are today, but it's going to take several months, I think, to get there and perhaps even lower oil prices ultimately.
Two more questions and I have time for zero. So maybe I'll make a comment. Maybe you can jump in. Number one, the underperformance of the home builders today is striking. The XHB, I don't know what's going on with that all of a sudden. Maybe it's interest rates. And then number two, consumer staples. I mean, this is an area, it's quote unquote defensive, supposed to benefit, blah, blah, blah. But in this environment, as Nancy Lazar and others have warned, could they lose pricing power and be one of the they're down 3% so far in the second half of this year. So would either of those home builder staples attract you here?
We're not chasing the home builders. I think it's all about interest rates there, so we'd be avoiding them because I think there's near-term rates are moving higher. We do like staples. Staples offer defense. They're not as expensive as they used to be. There are pockets of staples that could lose pricing power because you can't have packaged food companies raising prices 8 to 10%, a year and have it be a good thing. But there's other areas of staples that are reasonably attractive. The Mondelez, the Constellation Brands of the world, things of that nature that have sustainable demand that I think offer defense in a very choppy tape.
All right.
Through.
Maybe we'll give it 30 days, check back in. I'd love to see how this evolves. Chris, thanks so much for your time. Appreciate it today.
Thanks for having me.
Chris
Appreciate it.
Senyek with Wolfe Research, of course.